Welcome to this comprehensive 9-minute masterclass on India's Q3 FY26 corporate earnings. Today we go beyond the headlines to analyse the core drivers of India's economic engine. With 456 of the top 500 companies reporting, the data paints a picture of a resilient and expanding economy. Aggregate revenue has grown by a solid 11.6% year over year, confirming strong top-line momentum. Adjusted profit after tax has surged even higher, posting a 15% increase, indicating healthy margin expansion. This bottom-line growth is a direct result of improved operational efficiency and disciplined margin management across sectors. The real standout story, however, remains the small-cap companies, which delivered a staggering 32% PAT growth. Compare that to the 13% for large caps and 16% for mid-caps, and the leadership of nimbler firms becomes clear. Over half of the reporting companies achieved growth of 15% or higher. This breadth is a key indicator of market health. Let's look at specific leaders. Hindustan Aeronautics Limited reported a nearly 30% increase in net profit, with 10.6% revenue growth. Hindalco also delivered stellar results, with consolidated revenue up 14% and an all-time high India business profit of over 3,500 crore. In the auto sector, Maruti Suzuki saw a 22% jump in domestic volumes, driven by festive demand and GST rationalisation. Tata Motors also expanded its domestic passenger vehicle market share, while two-wheeler demand remains exceptionally firm. Ultratech Cement posted a 35% growth in operating profit, benefiting from strong volume growth and cost optimization. Financial services are also booming. ICICI Prudential Asset Management saw net profit surge 45% on 23% revenue growth. Tata Capital maintained its momentum with a 20% increase in profit, reflecting strong growth in wealth management. Sun Pharma recorded multi-quarter high EBITDA margins as the pharmaceutical sector focuses on high-value domestic offerings. A massive turnaround was seen at National Fertilizers Limited, with profits skyrocketing by over 200% due to subsidy improvements. Patanjali Foods also demonstrated robust performance, contributing to the broad-based recovery in the FMCG space. However, it wasn't a stellar quarter for everyone. IT services faced significant margin pressure due to new labour code costs. While Infosys saw revenue rise, net profit declined, highlighting the impact of these labour code-related expenses. L&T Technology Services also saw a dip in profit, although the overall sector remains resilient in its long-term outlook. Despite these pockets of pressure, the overall Indian corporate landscape is maintaining an EBITDA margin between 20 and 22%. Earnings per share growth is projected to reach mid-teen percentages for the full year 2026, a strong signal for investors. Inflation is also being managed effectively, with a forecast of 3.9% for 2026, close to the RBI's target. The broader macro picture remains bullish. For FY26, real GDP growth is projected at a robust 7.4%. Even looking ahead to 2027, forecasts remain strong, with expectations between 6.8 and 7.2%. This growth is fueled by massive capital expenditure, projected to reach over 12 lakh crore in the next fiscal year. India is strategically pivoting to become a global manufacturing hub, supported by initiatives like Biopharma Shakti. With 10,000 crore allocated to biopharma, India is set to become a global leader in high-tech manufacturing. The digital economy is also exploding, projected to reach 20% of GDP by 2030, surpassing $1 trillion. Private consumption is at its highest level in over a decade, with rural demand improving alongside steady urban consumption. This demand recovery is genuine, driven by agricultural performance and tax rationalisation for the middle class. The government remains committed to fiscal prudence, aiming to reduce the deficit to 4.3% by 2027. Externally, the shift in US trade deal sentiment is a vital tailwind for India's export-oriented businesses. A new trade deal could lower uncertainty and boost growth for emerging markets like India in the years to come. With $700 billion in forex reserves, India has a powerful cushion against global financial shocks. All these factors contribute to the Viksit Bharat 2047 framework, aiming for long-term strategic resilience. This vision outlines India's path to becoming an indispensable global economic powerhouse by its centenary. However, investors must remain cautious about global headwinds and sector-specific valuation stretches. The consensus from top broking houses is to stay focused on high-quality firms with strong cash flows. Favouring quality mid-caps and stable large-cap financials appears to be a winning strategy for 2026. As credit growth remains healthy, the financial sector will likely remain a pillar of any strong portfolio. Watch for the rural recovery to drive growth in FMCG and pharmaceutical sectors through the next 2 quarters. Improving agricultural yields are putting more disposable income into the hands of rural consumers. In industrials, order books for steel and pipes are at multi-year highs, reflecting a massive capex push. Global liquidity and RBI policies will be the key variables to watch as we head toward the mid-year mark. The RBI has maintained the repo rate at 5.25%, showing confidence in a softer inflation outlook. Analysts expect rates to remain stable through much of 2026, providing a supportive environment for business expansion. Retail participation in India's equity markets is at an all-time high, driving record assets under management. This democratization of finance is a powerful structural driver for the Indian wealth management industry. Wealth firms are seeing double-digit growth in fees and commissions, a trend set to continue into 2027. Market rotation is currently favouring domestic-oriented sectors over traditional global exporters. Industrials, capital goods, and domestic manufacturing are the current market darlings for 2026. The real estate and construction sectors are also major contributors to this broad-based economic growth. However, we must remain vigilant about potential shocks in the global energy and commodity markets. India's current account deficit could widen if oil prices surge, potentially impacting the rupee's stability. But with record forex reserves, the RBI is well positioned to manage any currency volatility effectively. A wider direct tax base is providing the government with the resources to continue its massive capex push. Healthy GST collections are a real-time indicator of the formalisation and growth of the Indian economy. This revenue allows for sustained investment in world-class transport and energy infrastructure. As we move toward Q4, look for companies that can maintain their volume growth without sacrificing margins. Disciplined management teams will be the ones to navigate any potential slowdown in demand. The long-term story for India remains incredibly constructive, with structural reforms paying off. We've covered a lot today, from stellar company results like HAL and Hindalco to the broader macro trends driving 2026. India is on a path of sustainable, earnings-led growth that sets it apart on the global stage. The journey toward 2047 is just beginning, and the foundation has never been stronger. Thank you for joining me for this 9-minute masterclass. Stay invested, stay informed, and I'll see you in the next analysis. Goodbye for now.